All right. So, welcome everyone. Before we begin, let me quickly introduce Plutus, the Finance Club. So, we are a student led initiative focused on making finance simple and understandable for everyone. Our mission is to spread financial literacy and help young people learn the skills they need to make smart financial decisions. We host engaging webinars like this one, covering essential financial topics from saving, investing, and budgeting to understand how the global events affect your money, and many more topics. If you'd like to stay updated, you can connect with us on Instagram, LinkedIn, YouTube, or check out our website as well. Uh, let's meet the speaker. Now, it's my pleasure to introduce our speaker for today, Mr. Abhay Mathur. He is the principal at the International School Agra and was recently a finalist in the Pearson International Educationalist Awards, ranking among the top four educators in Asia. He holds a degree in economics and has years of experience helping students and young professionals understand the world of finance and investments. His ability to connect real world financial trends with what's relevant to us is truly valuable. We're excited to have him here to help us understand how the global economy affects our money and our decisions. Over to you, Mr. Mathur.
Right. Aryan, good morning and good morning to everybody. Namaste. Thank you for inviting me. Am I audible?
Yes, sir. Also, a
Yes.
quick reminder, I'd like to request everyone to turn their cameras on. We'd like to keep this an engaging session.
Great, thank you. So first of all, I must congratulate you and your team, Aryan, for this initiative. Financial literacy is something that all schools have been trying to promote amongst its students. Because it's funny, we teach you everything in school that we think is important, and we don't teach you the one thing. We teach you how to make a livelihood, but we don't quite teach you how to at least how to be conscious of the savings and wealth that you will create over a period of time. And I think success is not just about uh, you know being good at what you do, but success is in your being able to remain sustainable. And whether you go ahead and you use your professional skills to create a hospital, or to create a business, or to work for somebody else's business, a sense of money is something that is really, really important. I mean, it's a life skill. I mean, if there was one life skill that you ever really needed, it would be this. There's also this sort of, the eighth wonder of the world, and that's the power of compounding. So the beauty about, I guess, investing and saving is that it's not necessarily rocket science. I know the movies will show you all sorts of complex investment strategies and huge fortunes being made, but I think at the very basic foundation of wealth creation is consistency of habit and not spending beyond your means. So I'm sure that this club is going to go a long way in creating that awareness. um, but obviously, the value of money and the value of wealth, a lot of it is connected to what happens around us, and not just happens around us in the local economy, but increasingly more so, because of globalization, our economies are interconnected, and events in faraway lands also impact our wealth. And that wealth could be in the form of stocks, bonds, real estate, etc. It could also simply be that it's not affecting your wealth, but it's affecting inflation. And if things happen which affect inflation, then whatever wealth you have, the purchasing power of that into the future diminishes. So there are many direct and indirect connections between events that are happening in the world and your wealth. And I'm sure that we're going to be looking at some of those as we go ahead. So thank you for that kind introduction. Um, and it's a pleasure to be able to teach economics. And what I find particularly exciting is that I did spend some time as an investment manager with Standard Chartered Mutual Funds many years ago, and a lot of the things that were happening in the economy in terms of the macroeconomic indicators, it would have a real time effect on our portfolios. And when I had to teach that later in life, the theoretical sort of underpinnings of that in class, I thought that it had made me a much better teacher, and a much more effective and engaging teacher, simply because I had seen the real impact of it. So whether it was, we'd be sitting in the morning on the day of a monetary policy committee meeting, and we'd be looking at each other in our office and saying, will they cut? Will they not cut? And suddenly something that you read in your theory books about monetary policy being adjustments in interest rate, for us was, it was 2 cups of coffee and a lot of stress on a Wednesday morning. So I think that that sense of realism is something that I think Aryan did mention, as one of the things which has made me a better teacher. And I hope that um, my this today's sort of presentation will also go towards making things real and interesting. So some basic sort of understanding about what the global economy is. Um, it's funny that we even bother talking about globalization or a global economy. The economy of the world has always been global. The issue is that the degree of interconnectedness, that intensity has gone up in the last, say, 30 odd years. And there's a reason for that. The reason is that the World Trade Organization has encouraged countries to seek greater wealth and greater prosperity through trade. So, what used to be typically very, very closed economies, there's been a movement in the last 30, 40 years to bring down tariffs and to trade with each other. And some of this you would have encountered, because I know there are lots of students in today's meeting. You would have encountered the basis for trade through comparative advantage, where while you might produce along your production possibility frontier, but if you trade, you can actually live a life well beyond the production possibility frontier simply because you specialize and you trade. Now, that's also connected to, I think, a general, the world has been a pretty peaceful place in the last 30, 40 years, if you ignore the last 5 years, especially. And that peace or the peace dividend has been countries' willingness to buy and sell goods from each other. The idea of all industries being a part of the projection of national power, that concept which we had up till World War II, that has generally sort of dissolved to a large extent, and countries trade, interact with each other far more. So we are living in an economy which buys raw materials from elsewhere and sells finished products, sometimes even back to the same country. My favorite example of this, and it's something that blew my mind away. I used to live in the Gulf. In fact, I've lived in the Gulf for many years. And somebody asked me, it was a trick question, that the petrol that you're using, where do you think it comes from? And this is sitting in Dubai. And I was like, we're sitting in the Middle East. What a dumb question to ask. Obviously, the petrol is from here, because obviously there are lots of petrol pumps. The price of petrol is relatively inexpensive. And the person told me that no, this petrol has come from India. And I was like, how did that even begin to make sense? We're sitting on top of the world's largest oil reserves, and you're telling me that the petrol is coming from India? And the idea was that while the Gulf has a comparative advantage in crude oil extraction and production, India and other countries of the world have sometimes a comparative advantage in oil processing. So it was working out cheaper for crude oil to come to India from the Gulf, but those tankers to go back with processed oil in the form of petroleum. So it's a little weird, but it's quite fascinating when you realize that the level of interconnectedness in the world that that we live in. So this also brings obviously complexities with it, and it matters because a lot of the economic trends that affect countries, they tend to affect indicators, and indicators immediately have a bearing on the health of your own wealth, whatever form that wealth is in. um, Therefore it's useful to stay informed about events, and we try and break those events down into broad trends so that we don't get completely sort of bamboozled by the number of things that go on. So there are five things going on right now. As if we look at it from the perspective of Indian wealth creation or the Indian economy, there are five big things going on, and I'm going to shed some light on those quickly. The first one is obviously the tariffs. Now, we're keeping a close watch on what happens on the tariffs, which Trump has threatened. And 9th of July, I believe, is the deadline when by which time we are supposed to have come to a trade agreement. If we don't, then obviously American tariffs will go up. We do export a lot of goods to America. America is an important trading partner for us. They're not just physical goods, but there's a lot of IT enabled services. And that will obviously impact a lot of the economic activity that takes place in our country. So tariffs is the big one, is the first big one out of five that we trends that we are keeping an eye on. The second one is oil. Now, there's an interesting statistic that every $10 change in the price of oil, crude oil I'm talking about, has a 0.4% impact on our inflation rates. And that's because India is a net importer of oil. We might be very good at processing oil, but the basic crude material we do need to import. Now, what happens is that if there is a lot of oil, or if there is disturbance in the Middle East in terms of shipping lane disturbances or production problems from Saudi, from Iran, then it's generally true that the price of crude oil goes up. So things seem to have stabilized, but it's been a busy last 3 weeks when it comes to dangers in terms of dangers causing crude oil prices to rise. So we need to keep an eye on that. That's number two. Number three is the US interest rates. Now, the United States of America is the world's is considered to be a safe haven economy. It's the world's most stable and safe economy, predictable economy as well. And there is some after effect of the COVID um, problems that we had. We did release a lot of money into our economies, and some of that sort of drunkenness is still there. So America has been trying to bring its inflation rates down. Certainly doesn't help when you have high crude oil prices, and it doesn't help when there's a tariff war going on between the US and China. But the point being that if America faces the danger of high inflation, they are likely to crank up their interest rates. And what happens when America puts up its interest rates, it becomes very attractive for the rest of the world, including American investment firms, to leave their money in American banks rather than go looking around for investment opportunities. So, a lot of the investments that come to India from venture capital funds or from other funds looking for better returns, when they find that the interest rates got cranked up back in America, they're less um, they are less motivated to come to India and park money in our stock market. So it has an impact on us. So that's the third big thing to be sort of keeping a watch out for. The fourth one is we are still fairly dependent on agriculture, although it would be a cliche to say that we are now still an agricultural economy. It's important, but not as important as it used to be. But the point is that monsoons are never predictable. And depending on how predictable the monsoons are and what impact it has on our own inflation, we will obviously see its effect on our wealth management. Um, if farmers do well, they buy goods. Remember, farmers are not just producers of food, but the farming sector is also a huge consumer of a lot of the industrial products that we make in our country. So it's really important that the farming sector remains stable and remains financially strong. The last sort of trend that we need to keep an eye out on is not necessarily related to global trends, but it's simply the exuberance in the market. If we find that there's a gap between um, the earnings and the current valuation of shares, then the correction that is always inevitable. There's always a a cycle in stock markets of corrections. That correction will be that much sharper. And what that does is when there are a lot of overvalued stocks, um, and they get corrected, they also pull with them temporarily down even stocks that need not have been corrected or did not need correcting in value. So you have this situation where if there is excessive amount of exuberance in the market, the correction will be that much stronger. So you obviously want people to be responding to events in a conservative manner and not getting extra sort of, those animal spirits should be held in check. So these were the five big things happening um, around us in the Indian economy, which we need to keep an eye on. And what can we do to make sure that we are impacted by these things to the least? We need to obviously keep some strategies in mind when we invest. Um, and I think one of the strategies that I'm going to talk about today is what's called rupee cost averaging. But before that, let me also just talk about currency fluctuations for a second. Now, currency on its own is not really um, I mean, I don't know of many people who hold on to currencies as a wealth management strategy. Companies do, because um, if companies need to buy stuff from abroad, they might buy that country's currency in advance, because they don't want to get stuck having to pay large amounts of money to a foreign country when the value of their currency has gone up. So, and the famous example of this is, I remember when I was, a school kid, or when I was learning economics. Just imagine Japan Airlines buying Boeing 747 aircraft from an American company called Boeing. Now, the payments for these Boeing aircraft are going to be made over maybe 10 years, but the earnings for Japan Airlines will happen in yen. Now, if your luck is bad and you're Japan Airlines, the value of the yen over 10 years will keep dropping, and you will keep earning your revenue in yen from your travelers, but your payments that you need to make to Boeing, the EMIs effectively that you need to pay to Boeing for those aircraft, the amount of yen you require to convert to dollars will keep going up. So companies such as Japan Airlines, what they will do is they'll go into the futures market and in advance buy lots and lots of dollars at a fixed rate, so that they don't get caught, on the back foot when, over the next 10 years they have to make their dollar payments. So they're hedging their bets. Now, people like you and me, we don't spend those kinds of, dollars. I mean, Japan Airlines was buying each aircraft at almost what, $200 million. But for us, maybe hedging our bets in a similar situation would be, we're going to go abroad to study for 4 years. We'll need $150,000. Obviously, this money is coming from your earnings in India, which is in rupees, most of it. And what happens if the dollar doubles in value against the rupee? Unlikely, but supposing it goes up, it suddenly means that in rupees, you now need twice that amount to pay for your education. Now, that's not easy, right? So, yes, holding on to currency can also be an investment strategy, or at least a payment strategy, if you know that you have certain payments abroad, which you don't want to be sort of stuck with, um, especially if your source of income is back in your home country. So, but in currency fluctuations, because most of the currencies that we are dealing with, they are mostly operating on a floating peg. You don't see very drastic changes. So we've never really thought about. I think there'd be very few parents out there who would say, "I must buy $100,000 in advance so that, or commit to it in the futures market so that my kid can continue studying in America." I have not come across, so many parents, or any parents for that matter, like that. Um, so now moving on to the strategy. I mean, the main strategies that I would suggest to anybody is that it's frankly very difficult to time the market. I mean, no matter what you see in the movies, no matter what you hear from people on TV, human nature tells us that when you lose big, you generally don't talk about it. And when you get a good deal or you've made a pile of money on the stock market, you crow about it very loudly on TV channels or amongst your family members. So don't get caught in this trap where you have what's called confirmation bias, that you only hear those conversations where people have made money. The truth is that there is an element of risk, there is an element of subjectivity. Everything is not it's not a perfect science, and one way to avoid that is to buy into, or is to save on a regular basis. Sometimes on the stock market, at least, sometimes you will end up buying stocks that are high, but there'll also be other times when you'll be buying when their value is low. And if you do this on a regular basis, for example, every week you buy something, maybe 2,000 rupees worth of mutual fund units, or every month you buy 15, 20,000 rupees worth of um, mutual fund units or even shares, you're probably better off. And I'll prove to you how you could be better off. If you go back and see the performance of the Nifty. Now the Nifty is it's an index of 50 of the most sort of uh, highly traded companies in India. They're not necessarily the most valuable, but they're the most highly traded, most liquid companies in the country. If you take the performance over the last 15 years and you did nothing, you didn't hire a fund manager, you simply put your money, you had 100 rupees and you parked your money according to the same weightage that the index have, you would have in any case earned 11% from doing nothing. And if you had put your money in the Sensex, which is the 30 largest Indian companies, ever since that index was started, I think it was in the 1960s, your compounded annual growth rate would have been 15%. So simply parking some amount of money and not worrying about buying and selling on a daily basis or on a weekly basis would have still given you 15% today, which is not a bad return, especially if this is not your bread and butter and you're simply trying to make sure that your wealth stays ahead of the inflation. Because if it doesn't, then obviously you're losing value over time. So rupee cost averaging, the idea of being regular and being consistent and not trying to be, a timer of the market, because honestly, nobody does that. Or very few people are able to do it. And most of the cases have a huge element of luck, or they have an element of something nasty called insider trading, which is where the person who's doing the trading on the stocks knows what is likely to happen, and that's actually an illegal thing. And as our economy, as our stock market is becoming more and more sophisticated, it's more and more difficult for people to do that kind of manipulation. All right. Um, Causes of global shocks. Well, we did discuss some of the shocks could be Trump's tariffs, some of the shocks could be the war. If, for example, if Iran blocks the Straits of Hormuz, then a lot of the oil that comes through that will get disrupted. So in fact, shocks are fairly normal. We have seen the big shock of COVID also come and go. Um, it does obviously impact things. Um, and I think in India, especially, we're a little lucky that the level of globalization is still relatively smaller than countries in the West or in Europe, or even, for example, Japan and South Korea. So we have some amount of insulation from shocks happening abroad, also because we have our own domestic economy, which is fairly large. And we can always turn to buying local products. They might not be the best products, but they're certainly available for us, if we choose to buy them, in case there is a shock abroad and there's a shortage of products, or foreign currencies go up to the degree that we can't buy those things. And a simple example is if the American dollar becomes extremely expensive for regular middle class to buy, then you don't need to go to study abroad to America. You can go to Ashoka University, you can go to Flame University, and they're pretty good. So we have alternatives, but not all economies in the world have alternatives, and sometimes the shocks for them can be quite drastic, right? Um, so inflation is one of the indicators which I would recommend. The reason we have it up here as a slide is because inflation is something that everybody should keep an eye on. So even if you don't want to put money in the stock market, even if you simply don't want to go into this sort of wealth management mindset, um, you need to be aware of what's going around you, because inflation is one thing that impacts everything that we say and do in the world of economics and in the world of wealth management also. Inflation is the idea that the general price levels of a basket of goods that people in that country normally buy, the general price has gone up. Now, it's very interesting that inflation is, in terms of priorities for any government, the government has many things it wants to do in its economy. It wants to keep prices stable. It wants to make sure that there are enough jobs. It wants to make sure that there is not a lot of income inequality. It wants to make sure that there is some amount of growth, and increasingly that growth should be sustainable in nature. But if you really had to put the macroeconomic objectives of any country on a hierarchy, it's funny and it's interesting that managing inflation, or at least keeping prices stable, is the number one priority. And it's even enshrined in the American Constitution. And the reason for that is, if you think about it for a second, if prices are unstable, everything else in the economy will collapse. Because the whole idea of doing transactions in an economy is that you can predict that the prices will remain fairly stable even next year. When you put up a business or you send your kid to school, you send you incur those expenses which will be recurring. You incur those expenses knowing or having the confidence that at the most it'll go up by 5%, the prices. But if you didn't know that the prices will go up or down, you would simply freeze up. You would prefer not to even undertake that economic activity if there was price instability. So, the number one public enemy for any economy is actually inflation. And what kind of inflation? The unpredictable type. All right. So, inflation, for example, now in India, inflation, and in most countries of the world, inflation is so important that governments are not allowed to look at it. The constitution of countries has given the responsibility of price stability to the central bank. And in India's case, that is the Reserve Bank of India. And Reserve Bank of India is very clear, including the Federal Bank in the US or the Central Bank of England. They will publish every year what their target is. For example, in India, the targeted rate of inflation. In other words, we don't want inflation below this or above this. The targeted rate is 2 to 6%. It's actually 4% plus or minus 2. If it goes beyond 6, we know we know that the central bank will crank up interest rates or do something to tighten up the money supply. And if the interest rate falls below, I'm sorry, if the inflation rate falls below 2%, then the central bank will panic or will find some way to encourage more money into the economy, more liquidity, and will try and encourage businesses to spend. So, inflation is something that I would encourage all citizens of any country to at least have a basic understanding of. And but inflation is really the quest for us to look for price stability. Even if prices go up over time, which is sometimes a healthy trend because it shows that there is demand for goods, it should be in a predictable and straightforward manner. Prices should not be erratic. Okay? Um, Moving on to interest rates. Aryan, feel free to sort of, if you'd like me to address anything else specifically, or we'll save it for question and answers.
Sure, sure. I'll let
All
you
right.
can cover what you'd like.
Sorry?
You can cover what you'd like, what you feel is relevant.
Okay, super.
Yeah.
Interest rates is another very interesting element. And of course, it is closely linked to inflation rates because interest rates is basically the idea that a lot of the spending in our economy, it happens on borrowed money. We borrow from each other. All right. Even the richest man in India, his businesses borrow because what happens is you don't necessarily always have money available at the time when you want it. So it's very, very normal, even for businesses which are very healthy, to borrow money to fund projects. Um, for individual consumers, increasingly, a lot of our big expenditure on houses, cars, electronic items, big ticket expenditure, a lot of it also happens through borrowed money. Now, borrowed money comes with a price. So if I borrow 100 rupees from you, I not only need to give back that 100 rupees after a year, but I will also have to give you a small reward for having given me the money and not done anything with it yourself. And that is really the interest, it's the cost of borrowing money. Now, the Reserve Bank of India or any central bank has the ability to influence interest rates. And I think it's not necessary for us to go into how they do that. But for us, it's necessary to know that when interest rates go up, when interest rates go up, typically it puts a brake on spending. Companies will borrow less. People who have saved money will sit on their savings and enjoy those high rates. And people who have to go and borrow money and spend, individuals, they might defer their purchasing of things because they just find that the interest rate is very high. To give you an idea, if I wanted to go and buy a motorcycle today, all right, and I went to a bank and I said, I need 100,000 rupees to buy a motorcycle, they will give me that money, but I would have to pay almost 15%, 15% for the motorcycle as the cost of borrowing that 100,000. So I would have to return 100,000 plus 15,000 rupees. And maybe the bank would be very sweet and they'll say, you can pay it back in 12 installments. So they will take 115,000 and divide it by 12, and that would be my EMI. So the problem with interest rates is that if interest rates are going up, then if every day there were 1,000 people buying motorcycles, with interest rates going up, that 1,000 people might drop down to 800. And the overall motorcycle market, which involves the producers, the spare part manufacturers, the logistics chain, the showrooms, the salespeople, the entire ecosystem of motorcycle production and sales would be impacted. So, interest rates, we've got to keep an eye on them. When they go up, that's generally a sign that the economy is now going to contract a bit. Why do we let interest rates go up? It's a whole different story, but interest rates might be pulled up when the central bank feels that the economy is already overheating. So it's a bit like a runner who's running really well but has is now panting and needs a break, needs a glass of water, needs some electrolytes. So the coach says, hang on, you need to slow down. You need to slow down, and that's exactly what the central bank does. So interest rates, there is a whole range of interest rates, but they tend to move up and down together. All right. Um, Global and local connections. The role of trade is very important. I mean, there are countries in the world where 60 to 70% of their entire GDP is built for trade. Such countries obviously have huge connections and are hugely impacted. South Korea is my favorite example. South Korea and India, interestingly, in 1965, had exactly the same economic indicators in terms of um, GDP per capita, in terms of health outcomes, in terms of education levels. I mean, to cut a long story short, they were equally poor. But they took a strategy that we will export our way to prosperity. And that also meant that they had to open their economy up. Now, there is a geostrategic sort of background to this. Obviously, South Korea was very much part of the US um, Cold War effort to contain communism. But the truth is that South Korea, 60 to 65% of its entire economic output is for people abroad to buy. Now, that's a huge global local connection to have. Um, these connections are good. We got lucky that our English speaking skills gave us a little bit of an uh, extra leverage in terms of connecting with the rest of the world. Of course, there were things that pulled us back also. For example, we did run a socialist economy for many years, and what that did was we protected our own we protected our own industries, and that wasn't a bad thing. But what that did was, if we are going to protect our economy and not allow others to sell, then others also did the same to us, and we couldn't sell to them. So we're not quite sure, our English speaking abilities versus our slightly closed economic sort of policies in the 60s and 70s. What was the net impact of it? But I think after 1990, when the economy did open up, and we didn't really have much of a choice then, we have done a pretty good job of making linkages with the rest of the world, and I think the economy is much better for it. I think there's also now an attempt to broaden our supply chain. In the last 20 years, a lot of Western businesses built their supply chains around cheap and high quality manufacturing in China. Now, obviously, as China has become more assertive, countries are worried about that, and they want to diversify these supply chains to other countries. And that's an opportunity for us. So, this global local connection that we speak of, this global local connection that we speak of, there's a lot of um, there's a lot of opportunity, especially in this whole geostrategic China shift of some amount of business out of China, so that we don't have all our eggs in one basket. Um, I mean, the IB, many of you are IB students, global local connections. I mean, a great example is the fact that you have Cambridge and IB available to you in India. So it's generally a positive thing. I think for Indians, engagement with the world has generally been a very positive experience. And we are quite, I think, open-minded. We've never really celebrated being insular. And I think that comes from our syncretic culture. We're generally quite happy to engage with the rest of the world. Um, Stay informed. How do you get your information? And that's another interesting thing for all of us. Because of social media and because of the algorithms, it's very easy to keep hearing what you want to hear, because once you start looking for certain things, they will push that information onto your devices. There still probably is a good case that you don't get stuck with only one source of information. I still believe that even newspapers have a bias, but newspapers' bias is far less pronounced than somebody only putting a message to you, or a newspaper article or an economic article to you that simply reinforces what you already think. Because that's really dangerous. That's really, really dangerous. But that is unfortunately the reality if you get your information only through a phone, right? And of course, meet and talk to people, because when you talk to people with different perspectives, and we've studied this, we knew that even amongst the American Monetary Policy Committee, when they decide to either reduce interest rates or increase interest rates, even within those nine people, there is a difference of opinion, and that's absolutely fine, and that's important, because again, like I said, it's nothing is a perfect science when it comes to running an economy, right? Um, and you don't want to get too heavily invested in just one point of view. You do need to hedge your bets. Um, Small investor tips. I certainly believe in the power of SIPs, systematic investment plans. Not all of us have the time to, track particular stocks. And even if we did, um, how would we time? How would we know? Especially small companies can sometimes make very dramatic shifts. So you don't necessarily get to see a trend, at least in the short run, um, about their general, trajectory. And also, you need a lot of patience, and not all of us have that kind of patience. Once we park our money. So dollar cost averaging was basically this concept of, you buy over a period of time, and the price at which you buy the asset, it gets averaged out. So you buy it sometimes high, you buy it low. And that's probably the simplest way to invest in the market. And that's something you've probably seen these advertisements on TV of something called the SIP. Well, this is exactly that. It's the systematic um, investment plan. Um, these are some common myths regarding investing. Um, Now, they didn't become myths out of thin air. Obviously, when people pervert a system, for example, investment is extremely risky. Well, yes, it is if you don't do your homework or if you try to time the market. It's also risky if you invest more money than you can afford to lose. So while it might be very exciting to put in huge amounts of money, if that huge amount of money is 90% of your income, then you're not being fair to yourself. So it's risky if you can't afford to lose that. Um, you need a lot of money. That definitely is a myth. And that myth, thanks to SIPs, thanks to mutual funds, that myth no longer holds. You you can invest with small amounts of money. You can invest with 500 rupees every week. That's absolutely possible. And only experts can succeed? Absolutely not. Like I said, if you simply in parked your money based on the weightage of the Nifty or the Sensex, then you've automatically got a 11 to 15% return. Um, do you need an expert to succeed? You don't, but it's always nice to have somebody who give you, some amount of advice. But also remember, experts sometimes they churn your portfolio because experts or relationship managers, a lot of the money that they make is based on a commission every time you buy and sell a share or you churn the portfolio. And I'm sure that most of them are ethical, but you've got to watch out for people advising you to keep chopping and changing because every time you change, you pay a service fee. So experts, um, they certainly can only succeed if they continue giving advice, but you don't have to follow that advice on a sort of on a too frequent basis, right? And students, set clear goals, create a budget, and start with research. Yes, this is certainly it's nice to do. I mean, it also depends if you have a source of income or if you are going to borrow some money from your parents, or if your parents feel that this is going to be a good habit for you to develop. So here's pocket money to you, 1,000 rupees a week, or 2,000 rupees a week. And the only catch is that unless you have a PAN number, you might not be able to invest directly on your own. But I'm sure your parents can figure a way out to that. But yes, your clear goals could be simply that you want to make a return of 10%. Um, and also your goal would be to learn about what trading is. That's if you want to get into trading. Um, so these are some general sort of statistics that we thought you might find interesting. Um, Economic changes in the economy have a real human effect. People do lose jobs, people do go into depression, people do stop buying things which impact others. And I think that the reason we have put these slides up here is to show you that if we just step aside from the fact that we're in this session to learn about wealth management and to learn about, some economic impacts of, the global economy, I think it's also our democratic duty, it's our citizens' duty to be following and aware about things that happen in our economy. It's also because we vote for our leaders, and you can only honestly vote if you have some sense of what their policies are doing to real people. So, don't just follow things like this as a hobby. Follow it because it's your moral duty as well to know about things around you. All right. So yes, it can be quite painful when job losses happen, but those job losses, hopefully, if the public is smart and if the leaders are smart, then they will park money aside when the going is good. There's something called economic stabilizers. So when the economy is doing really well, governments crank up their um, tax rates and they save that money for a rainy day. And what they do is when the going is tough and people are without jobs, then they transfer some of that money back to those people. Because even if you're super wealthy, you don't want a situation where there is large income inequality in your economy, because you don't want another French Revolution where the richest 10% of the public get their heads chopped off because the rest of the 90% of the public are so desperate and they are so upset. So we have seen some nasty, I mean, that's what civil wars have typically been. They've been driven by unequal wealth and very, very poor management policies. So please do keep an eye on such indicators and, enjoy your economics. It's not just a subject to be learned at school, it's a skill for life and it's your democratic duty. So thank you so much, Aryan, for giving me this opportunity to speak to you.
Thank
And
you for sharing your thoughts, Jane. We
I
have a
think this
quick
has been,
quiz for the participants. So, if crude oil prices rise globally, what will happen in India? Just answer in chat. Like it's a 1 to 3 word answer.
so do we have any responses?
Yeah, I'll just read them out. So, interest rates increase, inflation rises, high import bills, and inflation rupee depreciation. These are three separate responses.
Okay, great. So inflation rises, yes, because crude oil is certainly the raw material for many products, plastic products, uh, petrol that goes into our cars, diesel that goes into transporting things, lubricants. So yes, inflation goes up. And also, I think somebody said that it might worsen our balance of payments because what we buy from abroad, if that price goes up, um, compared to the value of things we sell to others, then we might get our balance of payments um, going out of whack. It would be called a current account imbalance. Great, that's well done, students. Next one. What is the meaning of compounding? Fine. What is the meaning of compounding? The eighth wonder of the world, the power of compounding.
We have a response saying reinvesting.
Sorry?
We have a response saying reinvesting.
Reinvesting, yes. So it's the idea that when you reinvest, if you leave your money parked, you know mathematically that if something is growing at even 1%, then it will grow. It won't take 100 years to double. If it's growing at 1% a year, in 72 years it will double. I think I'm not very strong at math, but it used to be called the 72-year rule, or the rule of 72, that 1% increase um, will not take 100 cycles to double, it'll only take 72 cycles. So compounding is a very important part of any wealth. Allowing things to compound is a very important part of your strategy.
Right. We have an accurate response as well. It's like your money is earning money. That's right. Like earning interest on interest on. That's right.
Yeah, yes, that's a
I
nice
think we
way of.
can go to question five. What type of DCA commonly used in India? We talked about this. So dollar cost averaging, I think it's rupee cost averaging here.
Yes.
So yes, that's right. It's SIP. So one question from me to the audience is when the US rises interest rates, what happens in the Indian stock market? I'll just repeat it. When the US raises interest rates, what happens in the Indian stock market?
So am I allowed to give a hint?
Yeah, sure. Go ahead.
All right. So if the US interest rate goes up, um, our stock market tends to go up when you have a lot of investors from abroad pouring money in. Will they continue to pour their money in if the US interest rates climb up?
It's not exactly weakening of rupee.
Sorry?
It's a response saying weakening of rupee. It's not exactly weakening of rupee.
Hmm. But it will certainly lead to the depreciation of the rupee. But
Right,
the
because of people, yes, that's right. People invest less in India. Not people exactly, it's foreign investors because they pull their money back and put them in the US for better returns.
foreign institutional investors typically, huh? I mean,
Right.
they're the ones who come in with the big bucks, right? They'll bring in $50 billion and take out $50 billion. We're not talking about the individual $5,000 being invested. We're talking about these large sums of money which push up the stock markets or have a significant impact on stock markets.
Right. Let's have another question. So let's imagine a war breaks out between two big countries. Not hoping it does. How does it affect your wallet sitting here in India? Again, it's a big war. How will it affect your wallet in India? Inflation indirectly causing inflation. That's right. That's right. Inflation is one of the outcomes and also causes market volatility. I think we can go to the next slide.
Yes. And it could also impact our exports because if those countries at war, if they are also big buyers of things that we sell, then it would we would lose our exports. I mean, Russia is a big buyer of tea, and the more Russia is dragged into the Ukraine war, um, it might. I mean, they might divert their spending from tea to other things. Um, so exports could also be impacted, not just imports not coming in.
Right. That's right. Any questions in the audience?
Sir, I had a question. So, even though the tariff situation is not clear and there's so much global volatility going on right now due to the ongoing wars, the S&P 500, the Dow Jones, and the Nasdaq index have just hit an all-time high. Is there any reason for that? Um, Curious.
True. So right now they're actually responding to the happiness that's coming out of the US and China likely to come to some kind of a trade deal because US and China are definitely very, very large trading partners. It's also ironic, but to some degree, tension in the Middle East is good for American arms manufacturers. Obviously, no one's saying that violence is a good thing, but a lot of American machinery and American technology is defense based. And up to a point, um, sales of that kind of stuff, led by uncertainty, um, does do a good job. Um, it's also American oil sales, thanks to the Russia Ukraine challenges and the embargoes, or rather the what are they called? Um, the penalties that have been imposed. I mean, uh, there's a word for it. It's slipping from my mind. Sanctions. I'm sorry. The word I was looking for is sanctions. With Russian oil being sanctioned, yes, in India we're buying Russian oil because we do things a bit differently, but the rest of the Western world, which has come to an agreement that they will be anti-Russia in the Russia-Ukraine challenge that's going on, or the war that's going on, um, they are not buying from oil from Russia or gas from Russia, but American sales have gone up of natural gas and of oil. So the American economy is not doing too badly, not doing badly at all. Um, so that's the irony of an interconnected world, that sometimes bad things happening in one place, they do help certain companies, but I think the biggest driver of the stock market in America doing well right now is just simply the fact that America and China, they seem to be finding a way out of what would otherwise be a pretty nasty trade war. So that's the only reason I can imagine.
Thank you, sir.
You're welcome.
All right. Could you please go to the next slide?
Sure. Yeah.
Yeah, any other questions, in the participants? All right. So, thank you so much, Mr. Mathur, for sharing your time, experiences, and insights with us. Your explanation of how the global economy impacts our finances was really eye-opening and valuable for everyone here. A big thank you to my Plutus team as well, especially Karthik, Krishang, Samarth, behind the scenes. Great help. We'd also like to extend our gratitude to Mr. Jitin Chawla and his team for their contributed support and guidance in making this initiative a success. I'd like to thank Bhavani ma'am and Jitin sir's team as well. To everyone who joined today, thank you for being a part of this session. Make sure to follow us on Instagram at Plutus_TFC, LinkedIn, and YouTube for updates. Highlights and clips from today's webinar will be available there. You can also check out our website, plutus.org.in, for upcoming events and everything that's happening at Plutus. We'll see you again very soon at our next webinar. Until then, take care and stay financially aware. Thank you.
Namaste.
Thanks, Aryan. It was a great session.